Yes, so in my talk today, I'm going to try to go over the basics of fractional reserve banking and why it has historically led the state to impose a compulsory deposit insurance scheme and how this all kind of applies to Bitcoin. So really just to begin, I want to get into the sort of definitions of terms here. All right, so what is banking? Well, the first term here is demand deposit. So what is a demand deposit? Well, it's basically your everyday checking account. I, the depositor, deposit a certain amount of money, gold, whatever, into the bank with the intent that it's always going to be available for me at any time on demand. Generally, historically, I would pay a fee for this kind of service through a storage fee or whatnot. Then the other type of sort of banking, just to make it real high level, is time deposit banking. So what is that? That would be basically I would engage in a contract with my banker. I would loan them money, and they would contract to pay me back a sum certain at a definite future point in time with interest. So those are the two kind of pieces that I think are worth mentioning. And as I said earlier, the storage fees. You would historically pay a fee to the bank to store your gold for you. That's the way the bank would make money. The last thing I have on my slide here is the Bank of Amsterdam. Historically, I think it started around the early 1600s to the mid 1700s. There was the municipal set up Bank of Amsterdam that kept 100% reserve for 150 years. So it has happened. There is historical precedence for that. Okay. So the next topic I'm going to really focus on here is what is fractional reserve banking. So what we need to understand with banks and how they operate, really understand why they're inclined to engage in fractional reserve banking in general. As I mentioned earlier, with a demand deposit setup, the banker makes a storage fee in exchange for keeping 100% of the deposits available at all times. On the other side of that, they can make money through time deposits, through lending. There's no creation of credit through all this. It's all, a reduction in one person's supply of money for an increase in the other person's. So it's not expansionary. But what happens with the banks when they do fractional reserve banking is, well, I'll kind of show the journal entries that might help understand. Okay, so what we have here is the initial deposit. This is kind of a basic journal entry where the bank would record an increase in the deposits, that's the debit side, and they would put a credit, which is a liability for demand deposits, because they've created a liability whereby they have to honor our contract. They have to have the money at all times. So we can look at the bottom and we can see what their books look like. On the left side, they've got my assets, my deposits, and the right, they have the liability. The next step, which is really the fractional element, is the bank sees these deposits sitting in their vaults, and they say, well, it seems that that this customer doesn't really come by to see if all the gold's here, all the money's here. And so what they say is well, we think maybe there's about, we only need to keep about 10% on demand at all times, meaning the other 90% can be lent out. The process of that is the fractional reserve. So we can see the journal entry that would occur here. They would debit the loans because they've created an asset, and they've credited demand deposits that is an additional liability. So we can look at the bottom and see the bank's balance sheet where they've increased their assets to 1,900, and their liabilities have increased to 1,900 as well to balance the books. But what we have to remember here is that they've created this money ex nihilo, Latin for out of nothing. So, is this right? Is this okay? And then if we go to this, this next slide kind of shows the ultimate profitability the bank has of engaging in fractional reserve banking versus 100% reserve banking. You can kind of compare the two here. Ultimately, what ends up happening, is the bank that engages in fractional reserve lending is going to get that, they're going to get a fee from me for my deposit. But of course, they violated that contract by lending it out fractionally, and then the other side is the interest that they're going to earn. That's the far right column. And you can see at the very bottom, it shows the profitability that they're making, the gross margin on their deposits. which is 10% versus 1% of just storing it, like the contract says they should. So is it any wonder for banks engaging in fractional reserve banking that they're so large today? Something to certainly think about. All right. Now, so all seems okay, I suppose, but what would occur or what would happen if I, the initial depositor, go to the bank and say, something happened in society or there's some uncertainty. Well, I want all my money back. Give me it all back. Well, here's the problem: they don't have it. So that leads to some problems, obviously, and we can historically know this as sort of a bank run, whereby all the depositors hear, through the community and whatnot, that this bank doesn't have the money. So the banks don't like this. They don't like a bank run. So what do they end up having to do? Well, the first thing they can do is be honest, is going forward, keep 100% reserves at all times. And I think just to kind of take a step back, is we've got to understand that the depositor, the initial depositor who deposits this money with them, it is a universal, it's a contract that they've engaged in. And it goes against universal legal principles for the banks to take any number other than the amount that, to lend any of this money out. They violated the contract that I've engaged in with them. Nowadays the banks have a legal privilege that violates universal legal principles to engage in this process. And then so as we can see, it leads to ultimately will lead to the boom and bust cycle, which is outside of the scope of this talk. But the next sort of piece, which kind of comes back to the whole point of my talk here, is deposit insurance. So going forward, the banks want to try to maintain these deposits and maintain confidence. They don't want people going to the bank and saying, give it back, I want my money back. So they go to the state and they, through a series of lobbying and whatnot, have the state create deposit insurance schemes. So I'm going to read a little quote. In 1913 is when the Federal Reserve was created, and I'll get to that in just a second, but that's when the Federal Reserve System was created, and along with that came the FDIC, the Federal Deposit Insurance Corporation that we know today. In this whole process of creating deposit insurance and the whole scheme, there was a debate that went on in the Senate, and a large senator and politician, John Weeks, stated in defense, or rather in objection to fractional reserve banking, he said the following. One particular line that stands out is that deposit insurance is, quote, a form of socialism which must be repulsive to anyone who deplores the socialistic tendencies of the day and is added evidence that the socialist is looking to the state to provide for him what he has not been able to provide for himself. So what he's saying here is that by having deposit insurance, banks who have historically operated in a sound manner, have held high reserves, are being penalized and are put on the same playing field as banks who don't maintain as high of a reserve. So it leads to further problems whereby the depositors are sort of, I would say, lulled to sleep in a way that they don't have to worry so much about the soundness of their bank. They sort of just take comfort, I would say a false comfort, in the fact that the deposit insurance will cover their deposits. We can see this is already being violated in the Cyprus example, and if you really look into the size of the FDIC's insurance fund, it's right around 30 basis points of deposits that they cover, which is 0.3%. So the second part of the consequence of fractional reserve banking is that historically it always leads to a central bank. When everyone goes to the bank to withdraw their deposits in a pseudo bank run, the banks cannot meet the liquidity requirements. They go to the Fed, they go to any central banks, and ultimately they print the money, give it to the banks, and everything seems sort of fine, but it isn't, because the purchasing power of everyone's money is reduced. All right. So now to the meat of my talk is the relationship to Bitcoin. So while many members, I would say, of the kind of mainstream intelligentsia might point to the lack of deposit insurance with Bitcoin as a bad thing, I kind of imagine that a lot of us may see the opposite. As mentioned earlier, the parties who really themselves push for deposit insurance, along with central banking, is many times the banks themselves. So like I had said earlier, by instituting this, deposit insurance policy, banks are able to sort of subsidize themselves in a way that they can be riskier and take riskier bets and make more loans and expand their balance sheet through fractional reserve banking more often than they otherwise could. So, what does this? How does this all come into Bitcoin? So, as I said, deposit insurance causes people to let their guard down. They don't go and see what loans is my bank making. Is it sound? They don't care. Ultimately, they don't care. But with Bitcoin, this is obviously not the case. Everyone's guard is up constantly. The continual hackings, denial of service attacks, and other issues have led owners of Bitcoins to be extra careful of where they store their coins. And I guess before I get into the next sort of section here, what I'd like to mention is what we have today in terms of the ways that you can own Bitcoins. There are e-wallets. I give an example maybe of like a Coinbase or Mt. Gox or something, where your Bitcoins and their associated private keys are stored on their servers. And to spend these Bitcoins, you have to use their apps or go on the internet and log in and send the Bitcoins around. So I kind of see that as a comparison to demand deposit banks that I'd mentioned earlier that are really storing your gold or your money for you at 100%, 100% of it. The other option is, and this is where we get into the be your own bank part, is that you have the option on Android phones, for instance. You can hold your Bitcoins and their associated private keys, which is really the value of the Bitcoin, or gives it value to you. You can store it directly on your Android phone. So this would be akin to maybe, holding gold coins at all times. You're holding the money on you, and you're not relying on a third party, an e-wallet or a demand deposit bank or a warehouse or something. You're not relying on them. You're completely relying on yourself. So now, if we go back to the topic of unsound banks. So like I said earlier, a lot of times bank runs are caused, everyone goes and pulls their money out, and the cycle goes on. Now, with Bitcoin, what ends up happening is there is lots of conversation and chatter on the Bitcoin subreddit or on Bitcoin Talk forums or whatever, discussing the security of these demand deposit e-wallets, demand deposit bank e-wallets. Well, all this chatter can lead to somewhat of a pseudo bank run. And I think there's actually historical precedence for this, of this kind of chatter about the soundness of banks. Jim Grant, financial historian and author, and editor at Grant's Interest Rate Observer, identifies this interesting precedent in his book, Money of the Mind. He discusses the aptly named Thompson's Banknote Reporter, which was a publication that first came to print in 1842 and eventually grew to be American Banker that we know today. The reporter advertised that, quote, fraudulent and unsafe banks will be pointed out and the public put on their guard where failures may be expected, regardless alike of the favor or ill will of the great financiers. The purpose of this publication was ultimately to, among other things, quote, agonize and crush any of these fog financiers. So what I'm making the connection here is, if there's an e-wallet that's unsecure, people on the forums and on Reddit will say this is a really sketchy operation, we should probably pull out. So there's some kind of interesting little precedent there. And it's also worth mentioning that the e-wallet providers they're aware of this chatter, and so they've really got to provide good security if people are going to use their service at all. All right. So then now we get to the possibility of deposit insurance with Bitcoin. As I said earlier, it's always been historically an institution of the state to set up deposit insurance. Is it possible for Bitcoin to have some sort of deposit insurance? And I would contend that it's pretty unlikely that something could come about in terms of your deposits. In other words, what I'm saying is, could the state come in and set up a state deposit insurance scheme that backs Bitcoin? Well, how would they do it? I mean, they don't have the Bitcoins. They would have to print. You can't print Bitcoins, so there's no way to really have it. And as I had said, it really distorts market forces of providing, or rather of forcing e-wallet providers to be very secure in their deposits and focus on security. So we see market forces, free market forces at work here. With the lack of deposit insurance, that at first glance seems like a bad thing, but ultimately the banks to attract deposits have to be very secure, and then the depositors win and the banks win because the e-wallet providers win because they get more deposits. All right, so the last thing, kind of skipping around here. The last thing I'm going to talk about is the prospects for fractional reserve banking with Bitcoin. So if we go back to the initial example I had given earlier, whereby one person, I had deposited money in a bank, they had, gone on to lend those deposits fractionally. Is such a thing possible with Bitcoin? Well, what we have to remember is that the initial deposit, when I put my goal, let's just say, in this demand deposit bank, they gave me back a bank note. They gave me a piece of paper that says, pay to the holder of this note X amount of gold, let's just say. And then once the loan was made, the exact same thing occurred to the borrower from the bank. He was given a bank note worth 900 units of gold. So what's happened here in that system is we have money substitutes, which is these banknotes that are circulating in the economy. And in theory, they would trade on par with gold. So I have a 100,000 unit banknote that says I own this much gold. It trades on par with gold coins. Now, the issue, and so in order to have fractional reserve banking, I contend you need to have money substitutes that exist in the economy like this. So then we get to the question of, can Bitcoins have money substitutes? Would I deposit Bitcoins in an e-wallet and receive Coinbase banknotes? And I would contend that that's pretty unlikely of occurring. It could happen, but it's a bit unlikely because if you think back to the gold situation where I've received a banknote in exchange for the gold I've deposited, there's a cost savings associated with that. It's easier to spin gold with banknotes than it is with carrying gold coins around all the time. But with Bitcoin, you don't really have that additional cost advantage that you would have with gold for having banknotes like that. They're in your wallet at all times. There's no additional storage costs. There's nothing. There's no real advantage there. So I think a lot of people who say that you can have fractional reserve banking with Bitcoin fail to kind of keep this idea in mind that you need to have money substitutes that circulate on par with Bitcoin. It's possible, but I just contend that it's a bit unlikely. Sure.
So Long has these tickets where you redeem for Bitcoin. So isn't that already happening?
So you're talking about what are they called again? I know you're talking about. Yeah, Gox codes. Gox codes. Yeah, I think that's an interesting point. I mean that kind of does circulate in a way as a money substitute, except for the fact that I could sell a Gox code to someone for U.S. dollars, but I could also just go into the Bitcoin network and get Bitcoins for it and then be in the system. So that's what I say. Like I think it's possible that you can have sort of substitutes like that. That's kind of what I don't rule it out. But for it to circulate on a really high level, on par with Bitcoin, to the point where the banks can expand their balance sheet through money creation, I think it's unlikely. Let's see here. So. Okay, yeah, and I guess the last thing that I think, a question that may come up or has come up with discussions with people just yesterday and today as well is the likelihood of voluntary fractional reserve banking, whereby I would enter into a contract with a demand deposit bank and say, all right, keep my money on hand, but you're allowed to lend it out fractionally. And everything seems fine there because it's a voluntary agreement. I know what they're doing. I know I could lose all the money, and I think that's possible. But I kind of think it's also, unnecessary to the point that, first of all, would back to my question or my contention that money substitutes wouldn't circulate. It just seemed to me it'd be better off engaging in a contract with the bank where I would loan them 5 Bitcoins and I would keep 5 in demand deposits or something. So. But I think thinking big picture in terms of the whole ecosystem and the Bitcoin economy is if we see these voluntary fractional reserve banks come around, I think a lot of people should sort of raise their eyebrows because it can have an effect on the whole economy. It can potentially, historically could lead to state-imposed demand deposit, deposit insurance or some sort of central banking. I mean, this is just kind of what it's led to historically. So I think that's kind of concludes my talk. Hopefully there's some questions. I know I've gone over a lot of things. I think he was asking to go to the mic. If you want to go to the microphone here, I can try to answer some question.
Testing 1, 2. Okay. Thank you for bringing this forward today. One here has done extensive research into the establishment through the 1863 Bank Act and the Currency Act of 1864. One of the things that people need to realize if they've ever read the Congressional Investigation Report on Domestic Finance and Credit, which is it's titled The Primer on Money from 1963. Also, the Federal Reserve published a thing called Modern Money Mechanics, which you might be aware of.
Sure.
Okay. So in regards to the deposits, most people are making a general deposit. They don't know there's such a thing called a special deposit. And when you set up a relationship as a special deposit, you're coming in as a trust. So that's one thing to look at. Any insurance scheme that anyone proposes is a tontine Ponzi scheme, and you would want to stay as far away from that as you can. Okay. Now the other thing, I don't know if you're aware of Title 12, USC 95A, Part 2. Are you familiar with that?
No, I'm not.
Are you familiar with Title 12, Section 411?
No.
Okay. That is redeem in lawful money, and the other one, Title 12 USC 95A, is full acquittance and discharge of all obligations. We're operating on a discharging instrument. A Federal Reserve note does not pay for anything, it discharges it to a future event. Are you familiar with that?
With it serving as debt and that kind of thing? Is it?
Correct.
Yeah, sure.
How you can never pay anything with a note. It's never discharged. And under 12 USC 95A2, it's basically states that a full acquittance. Now I'm not talking about acquittal, an acquittance. The contract is closed and it's discharged on all obligations. So you might want to check that out, because that can also be used in any time that someone charges you with something, like the so-called United States government, the DOJ. Well, the United States is a corporation. It's domiciled in Delaware. It has a cage number, a DUNS number, a SIC number, and an EIN number.
Sure.
So the other point I wanted to make was that in the evolution of Bitcoin, as it becomes more and more popular, people need to understand that the event and issue that happened when they were born is a conditioned precedent that they need to understand.
Who being they? The users of Bitcoin? I guess I'm just trying to...
Yes, because you mentioned Thompson's banknote.
Sure, yeah, reporter, yeah.
If everybody in this whole room, we have one thing in common. We were all made bastard orphan children by operation of law, constructive fraud. And look at your birth certificate. It happens to be printed on American banknote paper.
Sure.
They're used as a deposit instrument.
Yeah.
What's the question?
Well, we can talk after. We'll talk after. Yeah.
Right.
I think one thing I would just mention is what you said about everything being a note, Federal Reserve notes existing, and that's what we discharge whatever spending with. I mean, Bitcoins aren't those. They're I would say they're more akin to gold or specie. So that's what I would just add in.
I guess the question is, how much has your research taken into account all those other conditions? Are you are you even aware of them?
Yeah, sure. I guess the one thing I would mention is ultimately I'm not so convinced that banks themselves are going to be very happy with Bitcoin, because they're going to lose the fractional reserve ability to the lucrative fractional reserve ability. So, sure.
You brought up the use of fractional reserve banking in Bitcoin. What would be the Bitcoin holders' incentive to allow them to do that?
You're saying the depositor? Oh, yeah, great question. Yeah, I should have mentioned this. Well, generally, how it would work is maybe the Bitcoin bank that's fractionally lending could offer interest. I would be a bit suspect if you were to see that kind of thing. I know on the Coinbase page on their website, if you look through their facts, someone asked them, "Do you guys lend fractionally?" And they said no. So I think it's just something to keep an eye on. But yeah, it would be through interest. That would be the incentive. Sure.
I guess I had a question. This is really educational to me, so this is kind of naive. Kind of in the fractional reserve banking world, there's this incentive. People want leveraged finance, I guess, at some level, for a variety of reasons. So my naive question is, in the Bitcoin world, how will that demand be fulfilled? What types of contingent contracts or institutional arrangements do you think individuals will enter into to resolve that Because it's clear from what you said, it's going to be really hard. So how will it work?
Yeah, great question. So I think, well, as it stands now, so at the beginning of my talk, I kind of talked about time deposits. And it's sort of my belief that what will happen is, well, as for when, I don't really know. It would seem to me that we need the price to maybe stabilize a bit more, or there to be some sort of hedging opportunities to hedge Bitcoin price fluctuations before I engage in a loan at a fixed amount in Bitcoin payable at some point in the future. But I think what will come about is, yeah, I mean, just plain vanilla loans of time deposit loans of I will, the bank ultimately, an e-wallet service or whatever, will act as an intermediary whereby I, the depositor, would deposit money, or rather I would loan money. They would pay me back in a year with interest. They would go find parties who wanted to borrow the Bitcoins, and then they would make the spread on the interest rates. You know, the issue, you know, back to what I was saying with hedging and whatnot is, you know, with all the volatility, I don't want to get into a fixed contract to pay Bitcoin. You know, if I borrowed Bitcoins at the beginning of this year, payable at the end of the year, you know, it'd be a lot harder because I'm probably not generating my income in Bitcoins. I'm probably generating it in fiat.
So do you see capital formation taking place with Bitcoin, or do you see it as a transactional medium?
I think right now it certainly is a transactional medium. You know, there are Bitcoin stock exchanges that you can buy, exchanges of different Bitcoin-related companies, and I think maybe what we'll see is more of that, the equity kind of side of things versus debt through loans. But you know, I want to see it. I mean, that means the Bitcoin ecosystem is really growing if we have a full-fledged capital market system, and I think that's going to come about maybe through hedging. That'll make, you know, people more likely to enter into loan contracts. Oh. Anybody else? No, he's the, yeah, sure.
Don't we really want Bitcoin to remain at least partially a commodity and have that in its building just to keep all of these other things running?
Absolutely. Yeah, I think we do. You know, when kind of getting my sort of talk prepared and doing a lot of reading on this whole thing, I really just compare it to gold in a lot of ways of a physical species, and what the economy would look like in that kind of system where you wouldn't, you know, if banks maintain 100% reserve requirements and didn't fractionally lend, a lot of the world would be a very different place today. It would look a lot different because if you think about it, who would these people give their loans to? Well, it's going to be their friends. I mean, it's going to create market distortions and that kind of thing. So I think it looks a lot like gold. I think if you want to look at historical comparisons, that's why I pulled up stuff from that era. I think it's kind of like gold, and I wish the gold bugs would get more on board with it. They're coming around, but they're not there yet. And I guess last thing I would just put up. This is different. Just some additional resources if you wanted to read more about the history of money and banking. These are some things I put up there. The first book being very, very, very good. I would recommend it a lot. So, anything else?
Yes.
Yeah, sure. Oh.
I had a question about, or a thought, on the deposit insurance. Perhaps all the depositors would agree that in the case of, or a group of depositors would agree that in the case of the requirement for the insurance to be used, that they would all give back a portion, voluntarily give back a portion of their deposits to satisfy the thing. So you would have a kind of a contraction, maybe,
Okay.
of a large pool of people's deposits, and so that they would actually kind of pay back out, and then the value might go up. Anyway, it's just a thought.
Yeah.
See what I mean?
Yeah. Like, well, yeah.
A pooled fractional reserve, someone suggested.
Yeah, but I guess I just want to, you know, re-emphasize is be very careful if this kind of if fractional reserve banking starts happening. It's bad news. So, yeah. Sure.
Sorry to interrupt, but I just...
Oh, I've cited you in here, right?
I'm the guy on the point 4, so I have written quite
Extensively
a lot about fractional reserve banking. I wrote a master's thesis which includes this topic, and there's also an interview with me in American Banker Journal. I'm here so you can talk to me.
Yeah. I extensively used Peter's stuff on his website. It's really good. Economicsofbitcoin.com. So, all right. Thanks.